Now, before we kick into some of the data that's come out, it's worth looking at the ECB balance sheet. And we've shown other balance sheets that have started to roll over, but not the ECB. The ECB seems not even thinking of reducing its balance sheet and can't even manage stagnations. Total assets has risen by 6.1 billion to 8.778 trillion, driven by QE. Since the record in June, balance sheet has shrunk by just 57 billion. Total assets still equate to 81% of Eurozone's GDP versus the Fed's 35%. So this is what we were discussing when we looked at the policy errors that come into play here. And this is where we've seen them stay too long. And when you look at the sheer size, 81% of total assets, what is the ability to expand that? I mean, at what are you going to go to 100%? Are you going to go to 150%? Like, we've already seen what happened with the BOJ and the yen and the yield control curve, and that's playing out at a much faster clip here. Even there, and again, it's because it's all culminating where the BOJ was the first mover, and the ECB, for all intents and purposes for this conversation, was really the last to try this. So it's really going to be one of, they're not going to have the same longevity that the BOJ experienced. And that's where we see more and more pressure, where they're going to have to do something in the face of the current issues that the market is looking at. And I think they've been trying to defend the euro, which is currently at 97 cents to the dollar. And that's why when you look at this, we see more pain and more pressure where the market's going to force them to act. And that's when you're going to see the big blowout between German debt and Italian debt. And really, Italy is going to be the biggest one to watch to see how the market is anticipating these shift in rates. So when you look at German assessment of current situation, estimate was for 68.5, came in at 72.2. German expectations of economic growth expected at 66.5, came in at 59.2. So again, you're still seeing some good, some bad, but all of them in a contractionary basis with more pressure to the downside, given the export backdrop, the current account balance backdrop. Because remember, Germany is an exporting nation, so on a GDP basis, the X minus M is so important when you're looking at their current accounts. And as exports slow, import costs rise. That's going to put even more pressure here. And just looking at the Italian debt sustainability piece, you get an idea of where they sit versus everyone else. So yes, we'll talk about Germany and the pressure they have, but 68% debt to GDP. Then you look at Italy, 153% debt to GDP, which is why the anti-fragmentation tool, all of these pieces were constructed to try to protect Italy and Spain and to a small degree France, and trying to keep those rates within a certain, let's say, margin of error against them. But as we see that deteriorate, so will the ability to maintain that, especially when you look at the total Eurozone trade balance in terms of billions, expected to be at negative 45 billion, came in at negative 47.3 billion. So the pressure is on when you look at trade balance. Import costs haven't gone anywhere. Raw material shortfalls still remain. Germany and France announced large additional fiscal support packages, all trying to drum up the support. But fiscal support packages also create inflation. You're putting money back to people, and you're going against the ECB isn't really trying all that hard, but when they start the QT side, you're going to have more fiscal dollars sloshing around, which is very similar to what happened with the UK fiscal tax cuts, as well as the BOE trying to raise rates. This is that friction that we're going to continue to see, but it's going to play out at a larger scale across the whole Eurozone. Then the Bloomberg Eurozone 2023 CPI consensus forecast for CPI continuing to go higher. We see it going back up. The German consensus forecast for next year is negative 0.5%. We still think inflation is going to go up, that Germany's going to get worse, but just gives you an idea that people are finally starting to kind of true up their models for just how much of a struggle things are going to be. ECB rate hikes will eventually catch up with the Fed. The question is going to be how fast. And the longer they wait, the faster the market's going to make them react. And that's a situation you don't want to be in when you're trying to play catch up. And that's what the Fed found itself in, which is why the rate increases have been so aggressive for such a long period of time, because they waited too long. Now the ECB waiting even longer than the Fed is going to have a huge uphill battle. Again, this is going to create so much pain and struggle on the European front. And I don't mean to laugh because it's not funny, but it's right in front of you. You just have to look at what you've done and the issues, and then the UN comes out and says, "Well, people need to cut rates because this is terrible policy." It's like no. What they did prior to this was terrible policy. Maintaining these were terrible policy. Putting us in this position was a terrible policy. Staying too long was a terrible policy. Not when you're trying to now create what took a decade to form. So then when you look at Spain real wage growth, continues to fall. The collapse of inflation-adjusted wages in Spain is so massive that it's actually difficult. When you go back to 1995, the labor power has been so severely weakened over the course of the Euro crisis with the decentralization of wage bargaining. So again, this is only going to hurt local consumption even more when you consider wage growth and where wages are for the local European buyer. European sovereign debt market's the most likely source of the next credit event. And that's what people are saying. UK Euro area sovereign debt is now the number one view in terms of what's going to cause the next credit event. But the interesting thing is that was not on people's bingo cards in September of 2022. So within 1 month, it went from not existing to a 35%, 33% assumption that creates the next credit event. And you can see how quickly things can change, which is why it's very important to appreciate the problems that we're facing. U.S. corporate debt is now showing its cards, Euro area banks, and it's all coming to the rising rates and the shift we're seeing in the market, which I think is still being underappreciated, especially with the issues that are facing Asia, more importantly China, which we're going to talk about and really review in detail in the next segment.